Hello, good evening, and welcome to the webinar on creating wealth by asset allocation, jointly organized by LIC Mutual Fund and the Hindu BusinessLine. Don't put all your eggs in one basket is an oft-heard saying, and this applies to investments as well. Considering that the factors driving different asset classes such as equities, gold, or fixed income may not be the same, investors are often advised to diversify their risks on the path to building wealth. How does one allocate his or her savings across different investment options? What are the do's and don'ts? How can mutual funds be useful in this process? To discuss all this and give his valued perspective, we have with us Mr. Dhirendra Kumar, founder and CEO of Value Research, an independent provider of mutual fund research since the 1990s. Mr. Kumar is the editor of Value Research's popular website on mutual funds, valueresearchonline.com, as also their monthly magazines, Mutual Fund Insight and Wealth Insight. He is a popular columnist and a commentator in the print and electronic media too. Welcome, Dhiren.
Thank you.
We also
Thank you for the generous introduction.
Sure, good to have you here. We also have with us today Mr. Lav Kumar, Zonal Head West at LIC Mutual Fund. Mr. Lav Kumar has almost 20 years of experience in the banking and financial services vertical. Prior to joining LIC Mutual Fund in 2018 as Head of Products and Business, he has worked with Principal Mutual Fund, Aditya Birla Sun Life Mutual Fund, and also Motilal Oswal Mutual Fund. Welcome, Mr. Lav Kumar.
Thank you so much, Vardhani. Thank you for having me on the show.
Yeah, good to have you too. We will start the event with a short presentation by Mr. Lav Kumar, followed by a discussion with the panelists. Over to you, Mr. Lav Kumar.
Thank you, Vardhani. Thank you so much. So, friends, as Vardhani said, do not put all eggs in one basket. And so that's so well said. It's a pretty old proverb, pretty old saying, but in spite of that, we continue to do, look at assets, whichever asset is doing well. We look at only those assets in terms of putting that this asset has done well or this product has done well. So let us put all the money there so that we maximize the return. But that's not the ideal way, to create wealth. Wealth is always created by asset allocation, and that asset allocation should actually depend upon your risk profile. How much risk tolerance you have, what kind of goals you have, and based on that, you should actually allocate assets to different categories of products, so that you are on a very stable mode of asset wealth creation. So basically, the question is, all of us at some point or the other have money with us, whether we are students, whether we are working, we all have money. So, and I hope that some of you must have heard of Mr. Warren Buffett. So Warren Buffett started savings from the age of 16 years, and he said he was late. He could have started saving or investing much earlier. So now that habit is yet to be inculcated in Indians more, because we have money, we get pocket money, we earn money, but then we don't know what to do with money actually. And because we don't know what to do with money, then we do a lot of things around it. So what do we do with when you have money? You spend, you save, you invest. There's a lot of questions. So this is a very old saying. Do not save what is left after spending, but spend what is left after saving. See, it's easier said than done actually. It's very easy to say, because please first save and then spend. But then that's all about habits. How do you inculcate those good habits which leads you to wealth creation? And which is the biggest enemy? These are very basic slides. Which is the biggest enemy, in terms of your journey to create wealth? Inflation. What is the biggest and the most deadliest enemy? Is inflation, which actually stops you from, getting rich. And you all know what's the cost of inflation. 5 years from now, the money the lifestyle which is actually done at 30,000 rupees, at this 5% inflation, after 15 years, you'll require double amount of money. Just as 5% inflation, which is not even WPI. So there are two types of inflation released by Government of India data. One is WPI, we call it wholesale price inflation, and second is CPI, or the consumer price inflation. And you and I know in our daily lives that inflation is much more than the data released by agencies. So that's the biggest, enemy Now look at, suppose you have 1 lakh rupees. Just at 5% inflation, this 1 lakh will become 50,000 rupees. So after 15 years, it just become half at 5% only. So this is the most potent enemy which we have to fight when we actually have to embark on the path of wealth creation. So what do? You start early. You progress from saving to investment. See, we all save. India has a very good rate of saving. But we have to progress from saving to investment. We all work very hard. But is the money which we have saved is working for us or not? It's equally important that the money which we have saved should work for us. And so how do you do that? You benefit from power of compounding, make the money work hard for you. So how do we go about all these things? So first and foremost, as I always say, have a goal for your investments. Why do you want to save? Why do you want to invest? Is there a goal in your mind? And why I say this? Because investment saving may be a very simple product. I save. I can save in home. I can save in bank. I can save in FD, wherever. You can save money. You can keep the money in your wallet also. That's also saving. You don't spend. But then why are you saving? Why are you investing? There has to be a goal for that. So first and foremost, you decide the goal. Why do you want to save? Because according to your goal only, you can choose a vehicle which will actually help you in investing. So there are various options available. Indians traditionally, a lot of people may agree, a lot of people may not agree. What I have always been saying, and you all can correct, Vardhani, you also can correct me, that traditionally what happened to Indians, that we have been enslaved for millions and millions of years, actually. So, a lot of foreign invaders came and conquered us, and we were actually, living under constant fear that something or the other is going to happen. So, we used to save in gold. So that if we have to run away, the gold was most handy in taking that and running away. Or to that extent, gold was most handy in storing it also. You can store it in your house, you can dig a deep in your house and you can save it. And you can put that gold there. So that way, we have been a traditional lover of gold. Traditionally, we have saved, invested in gold. So that is just one option of saving. And we are not yet moving out of it. Still, if a major portion of our saving, if you look around, it is gold, it is real estate, and then it's bank deposits. We have not moved away from gold and real estate to that extent which we should have moved. That is called financialization of assets. It's still a journey which we as Indians are embarking on together. So gold, stocks, bond, bank deposit, insurance, property, mutual funds. Multiple options you have in front of you. You can save wherever you want to save. But thumb rule, why are you saving? Which asset class you are saving depends on these parameters. It should fight inflation for you. It should provide income when you need it. It should be usable in parts and portions. It should grow in value and appreciate over time. And it should be realizable at fair value and low cost. Now these can seem little jargonish in terms of these are idealistic statements. But I'll tell you, boss. Suppose you said that, okay, I will save money. I have invested and I have bought a flat of 1 crore rupee flat. Now you just want 10 lakh rupees. What will you do? Will you sell a bathroom or a kitchen and get 10 lakh rupees and still retain that flat? Is it possible? It's not at all possible. Take for example gold. So that is not usable in parts and portions. Even if I will assume for a moment that it is for inflation for you, maybe. But then you cannot use in part and portion. Now look at gold. Do you know even for a biscuit when you buy, you have to pay making charges and XYZ things. So when you actually go and sell gold, till the time gold has not appreciated by almost 20-25%, you will not get the actual value of what you have invested. So gold can be used in parts and portions. Sometimes it fights inflation in a very short span of time. In some years, it has given return better than inflation. But then it is not realized at fair value. And same goes for real estate. So these are certain conditions which should be met by the investment vehicle where you have decided to invest. And the best solution to all of this is asset allocation. So asset allocation is like a balanced thali. All the nutrients are important for our body to function well. Similarly, various asset classes are important for wealth creation. So as we discussed, what all do you have? You have property, gold, art, so NFTs, equity shares, mutual funds, PPF, KYCs, XYZ, all those things. So investment that grows in value and investment that generates income. So these are certain classes which actually generates income, and these are certain classes which grows in value. So property grows in value, it may not generate income for you, because if you look at, we call it a factor of rental yield. The rental yield in certain cities are very, very low. If you have that money to buy a flat, rather put it into a bank deposit, that will give you more return as compared to the rental which you get. So it's a notion, it's just a misnomer that you get rentals from the flat that may not be equivalent to the yield which you get from any other asset class. So there are certain things which give you regular income, like bonds, you can get regular interest, NSC, KFP, PPF, deposits, mutual funds. So now what do you do? Why is asset allocation important? So what happens, basically, it is important first and foremost to take care of our emotional need. Now what happens, anybody, I think any human being would not like to see his or her investments or saving go down. Even for momentarily, we are not used to it because we have a emotional value attached to it. So this asset allocation basically takes care of that emotional ride which we have to go through when we actually invest. That is called volatility. So it's always like that. When the market is at top, now it's at euphoria. Oh, I have done this, I can do this. When the market is all-time high, most of the stocks are running. On the lighter side, I got to know that there was a stock which has a name oxygen in between, and the company has nothing to do with oxygen. So in the Corona 2 times, the stock ran by 200%. So that's called euphoria of the market. So everything gets carried away. Just like that, I'm smart, I can do, maximize the risk when the market is all high. When the market is falling down, and say, no, it's fine, it will come back. And then when it goes down, oh, I made a mistake. So the worst enemy of investor is not market, but his own emotion. So sometimes you have to be emotionally detached with your investment. I and you, all of us would like the money to grow, and we're emotionally attached to it, but emotionally if you decide about that, you will not make money. So, of late what's happened, that Indian investors and these service providers or manufacturers have understood the need that there has to be an asset allocator fund or a balance advantage type of fund which actually takes care of your needs or invest assets in different point of time in different asset classes. So up till now, what we have seen in Indian market that investor or fund managers have actually devised a lot of products which balances your money between equity and debt, so that they can take care of the low or the volatility or the downside protection. And the new category has come up, which is a hybrid category called balance advantage fund. So they decide exposure between equity and debt depending upon the markets. So why balance advantage fund? We said that invest in different asset classes, but traditionally we have not been very successful in doing that. Our emotions come in between. Suppose I have bought a gold is at all-time high, I would not like to go and sell the gold. To ride over that, in fact, to that extent, if you bought a stock and you've lost, you're making losses in that stock, you would not like to sell it. Forget. On the contrary, if a stock has done well, you may sell it to book profits. But you're not willing to cut those losses if the stock is not doing well, and you can see that in the next foreseeable future, it may not do well. So that for those reasons, a new category was introduced called balance advantage fund. They invest in stock and other instruments, and they try to create wealth in long term. They are pretty stable in nature because they rebalance and they try to reduce the volatility. So the biggest enemy is actually volatility. So they try to reduce that volatility by allocating assets into different asset classes. So as I said, it's very easier said than done. And that's the reason why balance advantage fund. Because we do not know. Today at 61,000 level, I have been meeting investors, all type of investors, young, old, millennials, non-millennials. They have one question: what should I do at 61,000 rupees? Shall I exit? Shall I enter? I just have one question to them. Sir or madam, you may have been asking same question when the market was at 50,000 levels. So what was the answer then? If I would have told you that okay, you please exit at 50,000 levels and the market is 61,000 levels, you would have cursed me by saying that boss, I made loss because of you. So what is important is that it's not important that you want to time the market. How much time you are spending in the market is more important, and it's virtually impossible to time the market. So choosing right asset class, dynamically shifting between asset classes, selecting right stock, determining entry exit points, and removing those personal emotional biases. These are the factors which is better managed in a balanced advantage type of category or product. So the multiple models. So there is no bias towards any particular asset class, and it tries to keep a balance between risk and return. So who should look at these type of categories? If you ask me, that anybody and everybody should look at these. Investors looking for diversification, investors not comfortable buying stocks, investors who are looking at long-term wealth creation, and investors who have a horizon of 3 and above. So primarily, if you ask me, equity is not for anybody who wants to invest for less than 3 years. Actually, it is not. So in fact, I have a very different opinion. I would like to say to all my listeners that, boss, you have already said that you are investing into equity for minimum 3 years. So why don't you are open to the idea of locking your money for 3 years? Lock the money for 3 years now. So there's a new category called ELSS fund where you have an option to get ATC benefit. It's an optional, but it's not compulsory that you have to only for claiming tax benefit you should invest into ATC or ELSS. You are blocking your money for 3 years. You might look at ELSS type of product. That's my personal opinion. So look at those type of investments. So how it helps? What's the benefit? It helps to build a diversified portfolio. It aims to reduce the impact of loss in adverse market conditions and aims to deliver long-term returns with lesser volatility. These are the objectives of or the benefits of dynamic asset allocation. How it is different than any other fund? The dynamic asset allocation, the asset allocation is dynamic in nature. Any other fund is not that dynamic. It has no bias towards any asset class. It can go into equity, it can go into debt, it can go into liquid also. Protection against market cuts, relatively high asset allocation fund, relatively low in other pure plain vanilla equity funds. Probability of capturing the highs and lows is pretty high in balanced advantage, is pretty low in any other funds or plain vanilla funds. So that is all about balanced advantage fund and the category and how you can actually create wealth by asset allocation. So Vardhani, this was all about it. So over to you.
Okay. Thank you, Mr. Love Kumar, for that presentation. Yes, as you have mentioned, balanced advantage funds is one of the products through which you can achieve asset allocation without having to worry about how to time the markets. We have Dhiren here to tell us, because asset allocation per se is a much larger concept too, outside of what we have discussed here. So, Dhiren, I'd like to start by asking you, the basic premise behind asset allocation is that one particular asset class outperforms the other at different points in time. So if you have exposure to 2 or 3 or 4 asset classes, then you are covered. So is this negative correlation existent at all points in time?
This negative correlation is generally prevalent, but over a very short period of time, it may not. And that is what is very confusing to investors. You will come across a situation where everything is, interest rates going up, and so does equity. So, it's very difficult to make sense of it on a short-term basis. But on a long term, a year or so, it definitely catches up. We will never see a very, look at what happened. If there is absolute turmoil, I remember the worst situation in 2008. And there was complete disbelief in what was happening to fixed income. We had the first time an opportunity, occasion where, fixed income, there was a disbelief in US that they, some of these entities could default. And then there was a complete disbelief in equity. And that is when gold took off. And that was the takeoff of the gold, and from where it never came back. That was coupled with, some other variables happen, in the marketplace that, just before that, 2-3 years before that, the gold financialization was started. So it was much easier, for people to buy it very easily without actually going for the physical form. But generally it happens. Just to answer you briefly, yes, it does. Over a period of time, on a short-term basis, it may not.
Okay, so which is why we are here today to discuss how to go about asset allocation, I guess. So, is it true that because of these different natures of different products, is it true that if you do asset allocation, your route to your path to wealth creation is like really clear, or are there any pitfalls in asset allocation too? Maybe does it not work for anyone, or?
It will mostly work for anyone. The point is that many a times people look at optimizing the return or maximizing the return from asset allocation, and many a times people look at asset allocation as a tool that, oh, it did not do well. The point of asset allocation is not that it did not do well. The point of asset allocation is that it will save you from some of the grave situation of the market. You will be saved of the scare that actually drives you out of the market forever. And to be able to, and nobody has, it's far easier said, if you actually get into the questioning a person in good times, he will say that I have ample risk tolerance and, I can withstand it. I have no problem. And, you look at the 5-10% decline and you will see a completely different opinion. Investors' thinking is malleable. It changes with time. It changes with the state of market. And that is the point. You do an asset allocation, write it on a piece of paper and see it every morning. Make sure that it's there, because people change with time. People say that, good times they will regret. And it is also a regret avoidance vehicle. Many a times people think that, if you don't have asset allocation, what will you do if the market goes down dramatically tomorrow? It will not turn into an opportunity for you. And if you're not doing asset allocation, most people actually think in binary terms: time to be in equity, time not to be in equity. But that is not how it is. It is very difficult to guess the market. In 30 years, I have only learned that, you can't guess it.
Yeah. So this point was interesting, that the fact that, write your asset allocation down in a paper and then look at it. So that way, so what are the factors? So if I have to write on a paper that I'm going to allocate, say, 60% to equities, 20% or 30% to debt, and 10% to gold as part of my asset allocation, how do I decide? How do I arrive at it? Like, is there any guideposts for anybody? What kind of, is it based on risk appetites or goals, or how do we decide what is right for us?
Yeah, it is largely on goals. If you have short-term goals, don't even invest in an asset allocation fund. If you are likely to need the money in 2-3 years' time, don't even consider that. Put it in fixed income. If it is for a non-negotiable goal. If it is for a negotiable goal and in the next 5 years, down payment for your house, and it can well extend up to 6 years. If you get lucky, you can well buy it in the 4th year. Then go for it. Then there is another way of looking at it. I don't believe in this, risk tolerance, but I definitely believe in experience. If you are investing for the first time, you get scared faster. You're scared you're too scared. When you see that, what would have happened to an investor who invested in 2019, and in March of 2020, he saw whatever was his accumulation went down by 30% in 2 weeks flat. That is something which is very scary about equity. And it takes time to learn that you don't have to be scared of that. It is part of the game. It is the nature of the beast. And that is, and you live with it. So if you have been investing for 10-15 years, if you have been through these cycles, you get used to it. If you are early in the cycle, if you are getting started, always start with something like balanced advantage or something, because it is a steadier take on growth. You need to invest your long-term money into equity, but you have to invest in a manner so that you are able to develop a belief. And this is something which is really bad. It has happened in the first 10-15 years of the mutual fund in this country. People used to come and invest in a seasonal way. And investor psychology is like that. Investors are very excited about investing in equity when the going is good, and which is perhaps not the best time to invest. And the going gets hostile, or it's not very favorable. People don't invest, and that is perhaps a great time to invest. So they end up, and then there was no supply in the, if you recall, initial 10 years of Indian mutual fund. Funds used to be, largely closed-end fund, the Morgan Stanley and the Master Gains and things like that. Okay, so people could only come in that time, and they were disappointed, and they were disappointed for a very long period of time. They invested, they regretted, they had regret, and they never came back again. That is something, investors have 2-3 things to do in their first, if it is their first investment, which is invest in a conservative vehicle, invest somewhat regularly. Because even here, if you invest 10 lakh rupees, and that, this is not a guarantee, this is not an insurance against any decline. It will decline less, and it will not scare you as much. So, if you have 10 lakh rupee and it comes down to, the reaction of an individual on a 10% decline is not proportionate to a 10% gain. You can't, measure the emotion, but the emotion on a decline is very severe. So it is very important that a newcomer should start in a steady way, steady with his investment, and make sure that the money is not needed, because that is the third anxiety point. If you invest your short-term money and you need the money in 8 months' time, and you have invested in equity, so it's quite understandable that you'll be very unsure, and you'll be watching it day in and day out and trying to guess it, and you're always, in a state of anxiety. You will always get it wrong.
Okay. As we have discussed, so one of the ways is to, use mutual funds as a route. Another way is also, to do it yourself. Like, I choose to invest in direct equities. I choose to invest in fixed income products separately. And I choose to invest in a gold mutual fund or in any other sovereign gold bond or a gold financial asset separately. So now when I decide to do this separately outside of a fund which offers me the exposure, now, what is the typical thumb rule for taking equity exposure? Because on the one hand, we say we should have the risk appetite. On the other, we say that, equity is what beats inflation. Mr. Love Kumar was talking about how inflation eats into your savings. So equity looks like a necessary evil to many people. So now how do you decide? Is there any thumb rules? Like, for example, if you Google, you will find that, asset allocation to equity, yes, 100 minus age, whatever that is, you can put in equity, or 80 minus age. So how do we decide how much to put in equities, apart from the fact that, we understand that we should do based on risk appetite? Yeah.
No, I would say that don't go by by that thumb rule, but the biggest, most important thing is to actually think about it. How long is that? What is the time period when you're unlikely to need the money? I have come across people who are in their 70s, and they are unlikely to need that money, and they are fully invested into equity. They are experienced, and they don't need asset allocation. In the last 20 years, they have experienced the ups and downs, and they are generally happy because simply it has worked very nicely for them. And so, if you're not dependent on income, to be derived from your investment, it is fine. So following any of these thumb rules actually won't take into account, and every investor knows himself best. So you can really visualize it. The most important thing is that, I would not like to actually, I would not like anybody to follow or do too much engineering or too much mathematics about it. I would say that, people are generally very conservative, or somebody who is willing to take chances, and somebody who wants to become very passive with his investment, particularly on the asset allocation side. So I would say that, a third or a quarter of your money in fixed income, or a third or a quarter of your money in equity, or 50% equity, 50% debt. These are the three asset allocation which comes to my mind. Because there is nothing like 43.59% is something that, I don't have a formula which should actually give you an output like that. And you should not take into account any such thing.
Okay. So you're saying these things which you get by Googling, we should avoid and really...
Yeah, it may be a good starting point. You become curious, but, don't go and look at it. Don't try to find a solution. And I think, people have to, most of the answers actually lie, are with you. You have to ask this question yourself, and nobody else can actually help you do this. Try and keep it simple. As you were saying in the initial part of the question, that there are many ways of achieving this asset allocation. You can have an equity income fund, or you can have a hybrid, aggressive hybrid fund. You can have a balanced advantage fund. You can combine it yourself. You can buy the stocks yourself. You can buy some international stocks as well. So, there are multiple ways of buying it, building up your portfolio. You have to see that what you are comfortable with, what is easy to implement, who is the most disciplined one. And I think mutual funds do place a great, the disadvantage of, doing your equity and fixed income, assuming that it's a simple thing. And if you do an annual rebalancing, you'll be liable to pay the taxes on, your fixed income gains or your equity gains. So that's one. One paper and you are taken care of. Of course, one thing which I have, I complain about, and I'm looking forward to many funds, maybe LIC, that I've been evaluating, these hybrid funds, and I hate them because they are not disciplined enough. I greatly, I think most mutual funds, I buy them for 2-3 very simple convenience. No great advantage. They give me diversification, they give me convenience, and they give me discipline. If they are not disciplined enough, if they get greedy just like me, with the portfolio, that they try and drift it from 65 to 75 simply because that discipline. Because mutual fund is a very tax efficient vehicle. I'm not liable to pay taxes till I withdraw my money. And if a mutual fund is doing it, I'm not liable to pay taxes. And that is something what I'm looking at. I find that mutual fund actually carry on in the good times. Maybe it has something to do with the marketplace. The marketplace actually evaluates the best performing hybrid fund. And so everybody tries to generate, a superior return. But that is the wrong way, because a wrong way to generate, to evaluate it. And I have seen it, when there used to be a category called monthly income plans, it's not called monthly income plans anymore. But, I found that over a long period of time, 5-6 years period, it was even unable to match the fixed income which was available at the then prevailing time. And the disadvantage and the reason when I actually dig deeper into it, it was primarily because, they were not disciplined enough. They were behaving in the wrong way. Good times, they will be into equity. Bad times, they will not be into equity. Trying to do well at all times. So that is something. Discipline is something which we do evaluate, and now some great options are emerging.
Okay. So you're saying mutual funds per se are a good route, and it gives you various options to within the various categories of hybrid funds.
There is a convenience which you can't have. Otherwise, you have to worry about it yourself, which is very hard.
Okay, so your suggestion is like for first-time investors or investors who don't track the markets regularly, mutual fund route to asset allocation is a much superior route, rather than doing direct equities and fixed income and gold separately, and then monitoring, rebalancing, having to pay taxes and all kinds of hassles associated with it. Yes, that's a good point. Yes. Staying with your argument on hybrid funds and all that. So, we had Mr. Lav Kumar talking about balanced advantage or the dynamic asset allocation category. And you were also talking about hybrid funds, which probably follow a static asset allocation kind of a model. So what would you suggest, like as more dependable, or at Value Research, I guess you've done a recent study on dynamic versus aggressive hybrid funds, which also follow equity debt allocation.
Sorry, I didn't get your last. What's the question? We did the study, yes.
Yes, you did a study recently on dynamic asset allocation versus aggressive hybrid. So dynamic asset allocation, we had Mr. Lav Kumar explain to us the advantages of that category. So, for a beginner investor or for somebody the uninitiated, so what does your study show? What do you feel is a better category for the investors?
There are two different categories. The balanced advantage can actually swing in either direction. Then, and it can change color with times, and one has to see that how successfully it does that. And when it comes to the aggressive hybrid fund, I'm expecting it. There you have the disadvantage that it is dominantly equity. It is tending to be an equity fund with a allocation to fixed income, and that is where even there people get disciplined, so it actually nullifies the whole objective of getting into aggressive hybrid fund. But I find that both the fund categories, despite their ability to do something very well or not so, even in an average manner, they remain excellent vehicle for anybody getting started. they remain great vehicle for anybody in trying to invest meaningful amount of money over a brief period of time in this kind of market where things look very uncertain. And one thing is, assured about the market, that when majority actually thinks that things are scary, things are expensive, it has gone up in a hurry, if it does not fall, then at least it becomes very turbulent. And that is what we are witnessing. And that the turbulence is the problematic thing for most investors. When you see 5% swing on a weekly basis for a couple of weeks, then it scares you. And you just wonder that, maybe this 10% decline on the value on which you are sitting, maybe it becomes permanent. And when you take your money out, that loss becomes permanent. So equity is a long-term game. You have to invest for many, many years, 5 years, 10 years, 15 years, 20 years, 5 years minimum I'm referring to. And that is when it will be able to beat inflation. That is when you will have to build, you will be able to have the belief in it.
Okay.
And for that, I think the initial years are very crucial. Okay. After that, you can actually get into anything. You can get into an index fund, you can get into a small cap fund, you can get into an aggressive fund.
Okay.
But initial years, I think everybody should be here, either of the two, and both have different characters, balanced advantage or aggressive hybrid.
Yes. I'd like to bring in Mr. Lavkumar here. So this dynamic asset allocation as a category or balanced advantage, which is the other nomenclature for the category. As a category, this has seen a lot of inflows in recent times and all that. So, but when we see a lot of these offerings, follow different models for dynamic asset allocation, like sometimes it's based on the Nifty P or the Nifty 500 P, the price to book, market cap to GDP, GSEC yield to earnings yield. So I'd like Mr. Lavkumar to tell us how should investors go about choosing from among these options. So.
Yeah, so basically, what I would agree to an extent that sometimes we mutual fund people have actually made it a little complicated for investor to understand that which is the right kind of asset allocator we should invest in, and that's where the role of an advisor comes into picture. Because as you said, you can do a Google and you can find out 80 minus your current day should be your equity allocation, or 100 minus current day should be your equity allocation. And as Devendra pointed out, which I completely agree, that once investor actually matures, he is at 55 and 60 and he doesn't require the money. So he's like doing a succession planning for his next generation, putting 100% to equity. So there the role of an advisor comes into the picture, that he should have a very good advisor. Now, whether that advisor is a mutual fund distributor or advisor, whatever legal and technical term you call it, but you have to have somebody who is mature enough in the market. If you ask me personally, we have also studied various models actually. I've been into this business since pretty long time, worked across various organizations, and I've looked at various models. Sometimes somebody say, okay, look at market cap to GDP. Look at PE, PB ratios, XYZ, etc., etc. But the two things I will tell you, and I'll tell the audience also, that today your interest rate is a historic low. Correct? We have not seen these historic lows in recent times, especially the millennials. And your equity market is a historic high. So I per se see a direct correlation between interest rate and your equity valuations. So a good amount of liquidity, and it's not just now, it has always been in the market that whenever there's ample liquidity in the market, your stock prices goes up. So on a basic thumb rule point of view, look at your GSEC rate or the interest rate and then your equity market. Any such fund who is actually factoring in that should do well. Now, having said that, you'll have to, that's why I said you should have a good financial advisor who actually goes into the model, understands it, and then looks at your requirement and then advises you. But primarily, two major factors move the market: liquidity and earning it. A company should earn to grow. So two factors, your interest rate and the stock price earning, should actually be factored into that model for the model to give you lesser volatility and decent return, or maybe matching your expectation and managing your emotions. That's most important.
Okay. In the course of this discussion, one thing struck me. We talk a lot about equity and fixed income and a little bit about gold. So I have a question to each of you. The first question probably I'll ask Mr. Dhirendra Kumar. Do you, Mr. Dhiren, do you really think that we should have more than two asset classes? Is equity and gold enough? Is equity and fixed income alone enough? Is asset allocation, does it necessarily mean having more than two?
Yeah, I think, equity and fixed income is good enough. And gold should be looked upon as a jewelry. It should be ornament. And, you should have some, and, it should look at it as a consumption, look at it as, it has some purpose. Historically in India, it has relevance because, that is the Sridhan. That is, what women will actually catch. That is their only asset many a times.
No, but this seems to be against a lot of advice coming now to invest in, ETFs and SGBs because
SGB, not necessarily, because, if you are a gold believer, that is the finest form of owning gold. At least it will get you 2.5% more. And, there are, because it is such an integral part of our community, of our society, in any region of the country, that it is the need for many people to accumulate their savings in gold so that they can exchange it for real gold as and when they need it. Think of it like a daughter's wedding investment. So I think that's the way I would look at it. And equity debt is good enough. And as I was telling you that, there are two components to it. What allocation to have and, how to look at it. I think allocation should be completely governed by your state of mind. There is if he's a person and he gets upset and, he has, even despite the experience, he should have 30% into equity just to combat inflation. Otherwise, you'll be left in the lurch. Likewise, 30% into fixed income, because the worst times you will not get an opportunity. 50-50, if you are going to, if you really want to sleep on it and, you don't want to do much and a 10% change in allocation, then only you rebalance it. So I think the starting point of allocation should be, for an investor should be, what they will be comfortable with. And it should start with fixed income. In all the models that you refer to, it is dominantly driven by the state of the market, which governs the equity allocation.
Right.
And then comes fixed income allocation. I think, fixed income allocation should be decided first, that this is the money which I want to have handy all the time. Whatever, hell happens, this money will be there. Debt, fixed income will always remain, is not risk-free, but always remain much steadier than equity.
Right.
So that is what should be the primary driver of your thinking.
Okay. So you're saying even outside of mutual funds, you can have a separate fixed income portfolio for the debt portion of your asset allocation. Got it. So this other question I had for Mr. Lav Kumar. So interesting, in your presentation, you had something, art as a form of investment. And then in the course of your presentation, you mentioned NFTs. So, and I also see a question from the audience on crypto investing. Europe has started crypto ETFs, and so there are these newer asset classes emerging. So, even instead of physical real estate, you have REITs and InvITs. So people are also looking at international funds and international stocks. So what is your take on this? And, do you think good asset allocation should start, also involves looking at these neo instruments?
So, Vardhini, all this discussion actually takes me to a very basic question, that what is your objective? Now, having said that, as Dhirendra was saying, equity and debt are actually good enough to take care of your needs. Now, what happens, to be very honest with you and the audience as well, what happens, all these are very fancy things, but then these products are basically for investors who's matured in an investing cycle. Definitely not for millennials. And having said that, I completely agree that probably crypto or NFT is catching up the imagination of people. But then, one, we have to look at current regulation of the country where you're actually investing into and from where the money is going to come. Second thing, you'll also have to look at what kind of risk is associated with that. And as I have always been believer of the fact that investing is more about emotions and psychology than actually about investing. So your expectation of risk and your expectation or your tolerance to that loss which can happen decides where in which asset class you are actually going to go into. Second thing, which I always believe that all these jargons, etc., 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 is only for investors who is looking at a 5-year investment. You take 10-year, you take 15-year period, and you'll be completely done away with all these things. You choose any good fund, and you stay invested for 10 years and 15 years, and I can tell you for sure, you will be happy with that. So investment is not just about picking up one asset class or the other. It's also about our state of mind, as Devendra was saying, and then you have to graduate. See, it's like that. Can you do an MBA without doing graduation? Certainly not. So I would advise that way only that to buy and to get into an NFT or to get into crypto, you have to actually first have this cycle and then you go there. I would not say don't go there. If regulation permits, please go there. But then for that you have to have that kind of maturity and you have to graduate to that cycle to go there.
So we go back to what Dhirendra said, that the plain old fixed income and equity is more.
Absolutely. See, for next, I can tell you one thing. For next 20 years in India, these two asset classes will be sufficient for Indian investors to actually, take care of the needs.
But there's a question comes to my mind here. Like either of you can take this question. Do you think asset allocation is necessary at all times? For example, let us take today's scenario. So equity markets are overvalued. Everyone is waiting for the crash to happen. And at the same time, interest rates are very low and most debt products don't look attractive. So is it a good, is allocating your funds to cash? For example, I book profits in equities and I probably don't invest afresh in debt. So, and I take a cash call and say, like, let me put it in, my savings account or my flexi deposits, or even keep it under my pillow. So these kind of calls, is it also allocating cash also? Is it part of an asset allocation strategy?
So cash has always been part of asset allocation strategy. So, so see, you started that, you answered this first question in your first statement only, that don't put all eggs in one basket. Now, even if you feel that, this basket is best basket and all the eggs will hatch, I agree. Like equity. For a long term now, all will blossom. But what happens if the basket falls down and it breaks? So we are actually preparing for that possibility when we are allocating assets. So cash has always been part of that, and that's where this dynamic asset allocation has come into picture. As I said, I will again reiterate, you give me money for 10 years and I can tell you I just put into plain vanilla equity or an asset allocator fund and I know nothing about that and will be happy after 10 years. I have to manage your emotions in the intermittent period, and that's the most important part of the job. And that's where I say, okay, if the Nifty P has gone above 32, which is 20-year historic average, I will put more money into debt, less money into equity and XYZ kind of thing. It is just for the intermittent 5-year expectation management, frankly, if you ask me.
Okay. Dhiren, what's your take on cash calls?
My take is that, don't do any of those. Simply because, what we are thinking right now is exactly what we were thinking last year too. And market has made the biggest move since then. And if you are going to remain invested for 10, 15 years, it won't matter.
Okay. So you're saying that at any point in time, we should invest and rebalance as per market conditions.
Yes, and we should be, if you're disciplined enough, we should do that. But I'm little tempted to answer one of the questions which Love answered, which was, little nuanced, and I would like to be a little more specific. One is this cryptocurrency. The whole world is getting excited, and it is quite exciting. Simply because, there's absolute madness, new kind of crypto getting created, a new ETF, which is a very unusual structure. Here is the crypto ETF, which does not hold ETF, which does not hold crypto. It is based on the price changes in the stock market.
That's right.
It's quite an unusual structure. So, and investors are very excited about it. It is still not a legitimate way of, exchanging money. And I have come across, all the kind of, smuggling, all kind of criminals. For them, the high ticket exchange of, current money, crypto has been the way to go. So in that sense, I'm a little apprehensive. But, every investor has this great temptation to, have some fun. And it's too exciting, too difficult to resist. And I think it's a human instinct. Have some fun allocation. Have 5% of your money if if it is a small shape of your thing. Otherwise, if it is a large corpus, have a defined amount of money and have your fun. What will happen is that, if you lose it all, you won't mind. And if something happens, you will have fun, and the fun will become real. When it comes to REITs and InvITs, early days, but they are very promising categories. It is liquefying something and making it accessible to investors, which was otherwise not accessible. And it's a different kind of real estate. Most people think that it is buying some property through somebody. Yes, it is, but with a rental yield and is a steady income. So it's actually, one has to look at it more options. And one has to look at it as a hybrid avenue, hybrid option in itself, which is which has some capital appreciation potential and generating some income. So it requires it still needs some more time for one to have to develop a belief.
What about, since you are on the topic, I also asked Mr. Lavkumar about international funds or international stocks. That is also becoming like, people are beginning to recommend, as you said, 5%, 10% of portfolio allocate to international stocks or international mutual funds. We've had a spate of launches also in the last year. That is more promising, isn't it? What would you say, Dhiren?
No, international stock, I don't look at it as a fun allocation. I look at it as a mainstream allocation.
Okay.
Equity is something whereby you are entitled to the ownership. And you are looking at promising growing companies. And international stock, I don't look at it as a cryptocurrency. I referred that, it is your fund allocation. If you are going to buy some Indian companies which actually move up and down 10% on many occasions during the year, I think they will also qualify for being in the fund allocation. International stock, I think they should be mainstream, and investors have now available vehicles. It is very convenient. In fact, most investors can buy these stocks directly. They can buy the ETF, they can buy the funds, and they can buy an Indian fund which has some allocation. So, the multiple ways of owning it, and one should have it.
Sorry, I lost my connectivity. I'm back. Sorry.
Yeah, you're back.
Yes. So Dhiren, I hope you explained it to the audience. I don't want you to repeat it unnecessarily. My last question was on rebalancing. You had mentioned it earlier as well, once or twice. And we also have a question from one Mr. Nagarjuna, who was asking about the time for revision and rebalancing. So how do you decide? Is it only based on market conditions, or is it going to be based on political, economic environment? He asks whether you should probably do based on situations like this COVID pandemic and all that. So how often?
It should be entirely based on your allocation. The way you can rebalance only if you have a stated asset allocation. If you decided that you will be invested 50% into equity, 50% into fixed income, you were faced with March 2020 and there was an opportunity to invest in equity. You need courage and you need discipline. If you do that, you will benefit from that. If you try, and you will also have to frame some rule that don't overdo it. With 1% change in value, if you go about rebalancing it, you will just create your life very difficult, and you will create a lot of tax incidents, which is avoidable. So, put some margin, that 10% change in the asset allocation, and you will act. And if it changes 15% in a hurry, you will definitely act, even if it amounts to, tax incidents of any kind. And I think, having that rule, sticking to it, that is the only thing, nothing else.
Okay. There was another interesting question, Mr. Lavkumar. I'd like you to take it. An anonymous attendee wanted to know, LIC is coming out with an IPO. What impact will it have on mutual funds?
So I am not entitled to answer this question, basically.
Okay. If I were to answer it, I would say that is different. This is different. Dhiren, what would you say? Should people look at funds based on its own merits?
Yeah, it should be looked at very objectively.
Yeah.
And there are merits, there are advantages, there are disadvantages, there is the public sector discount and this and that. And, there are 50 things which people will be looking at. And so, it should be evaluated based on its merit.
Okay, so there's another interesting question from one Mr. Rajashekaran. So we were talking about gold, fixed income, and equities. Now, this person is very updated and he wants to know about silver ETFs. Should you consider allocations to silver ETFs? Dhiren, can you take this?
Yeah, I would say that, silver ETF, yes, it is very much in the pipeline. SEBI was seriously considering it to give approval of, and somebody will launch it. But I don't see how does it fit into anybody's portfolio. And so avoid. I'm a strong believer of keeping it simple. Keeping it simple to the extent that, if you have to, just spend 10 minutes in a year, you should be able to intervene or take a stock of things. And that is why mutual funds were invented. That is why aggressive hybrid funds were invented. All these things, you will get a lot of these things coming your way. There will be IPO season, there will be this season, there will be that season, there will be new alternatives. Your friends will be making money on something else where you have never invested. Then the crypto is very much here. We are living with it. And we are still trying to decode and without any luck. So I would say that keep yourself shut. There will be noise. And keep it simple, believe in it.
Okay. There was a question on, we talk about rebalancing and reallocation and all that. Someone wanted to know when one should book profits in mutual funds. Is it so? I mean, how easy or difficult is it, Dhiren, to book profits in mutual funds when you're rebalancing?
Oh, it's very easy. If you are sitting on gain, you can book profit anytime. But should you? The key real question is when you should. What should prompt you to book profits? Two reasons why it should prompt you. If you have achieved your goal, book it right now. Assuming that you are investing for 5 years and you are thinking that, okay, once this money is accumulated to the extent that you can buy your car, and it has happened in 1.5 years' time, take the money out and come back only in the car. There can't be anything more than, achieving a goal which you have set out to, and it has happened before time. The second thing is, you chose a fund because you liked it for XYZ reason. And those reasons have disappeared. You liked it because it was withstanding the market better. You liked it because it was doing better in a falling market. And it has stopped doing it. And immediately after you invested, that's the reason to sell. But, one important question which you have to answer there is that how much time do you give before evaluating it? Should you look at 1 week's return, 1 month return, 3 month return, 1 year return? I would say that don't get out of a fund because every fund goes through ups and downs regularly. The finest of fund, the most rewarding fund also had a bad patch and a long one. So I would say that give it a time depending on the background. If a fund manager has been outstanding for the last 20 years, maybe I'll be willing to give him 2-3 years. And, mind you that when the fund is not doing well and you are still investing, it is beneficial. You are buying low with the hope that, okay, someday it will actually turn around. And try and understand what is going on. And that's about it. When a good fund turns bad by your definition, get out of it.
Okay. We have 1 or 2 more questions probably on, mutual allocation to mutual funds per se. Someone wanted to know, how much to allocate to passive versus smart beta versus active, or what is your opinion? Yeah.
I would say that, even here, keep it simple. I understand that there is a case which is getting built up for passive against large cap funds. But, the Indian market still holds a lot of promise in the mid cap and the small cap. So maybe for your large cap allocation, buy that. Put your money in the cheapest passive. You can invest in a fund at a 10 basis points, 5 basis point expensive, and you can't get better than that. And remaining money, then you have to make sure that you are investing in the good mid cap and small cap. but then rebalancing in them will be your problem, or your responsibility. And I think a basic thumb rule which one should follow is 70-20-10, which is 70% allocation to large cap, 20% to 10 mid cap, and 10% to small cap. And after the SEBI's classification, the style purity of most of the fund is very much intact and prevails all the time.
Okay. Just take the last question. You did tell us about booking profits in mutual funds. One of the reasons, like if you've reached your goal or whatever. So someone here has asked, what is a reasonable XIRR return to assume when you're booking profits in funds? So
it changes with time. If you have got something like 20% return in the last 25 years, I would say it is not a great return. It's a good return, or it's a above average return. Nowadays, if you get about 11% return, I would say it is an outstanding return. So, the return expectation, or the return per se, is a function of what is the prevailing, what is the prevalent situation, and which is very much in line with the inflation and the interest rates and the fixed and the equity premium. So I would say that today, I would say somebody is able to sustain a return of 12% from equity, I will give it an award. And greater the consistency, greater the acknowledgement.
Okay. Those were the key questions I thought I could ask you. So it's been an hour since we started. So been a very good session, very enlightening, a lot of questions and a lot of answers. Thank you very much, Mr. Lav Kumar and Mr. Dhirendra Kumar.
Thank you, Vardhini, for this opportunity.
Yes. Thanks to the audience also. Hope you had a very informative session. See you again.
Thank you.
Yeah.